Hello, chart watchers, and welcome to this Thursday, May 30th, 2019 Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Let's take a look at the market action today. After a lot of the selling recently, we're trying to bounce back, but it's not easy. Dow Jones Industrial Average currently up 9 points, the S&P 500 up 3, the NASDAQ 16, and the Russell 2000 unable to sustain its earlier gains, back down near the low of the day, down 1 point. 10-year Treasury yield, well, we're higher, but off of the earlier highs. Not exactly a great-looking candle right there. The 10-year Treasury yield up 1 basis point to 2.25%. Volatility index is declining, so that's good news, down 2 1/3%, back below that 1750 area, but still within this uptrend, so we do need to be careful here. Real estate leading the rebound back to the upside. Consumer discretionary also having a pretty good day. But the laggard, once again, is energy. This has been a group that has really struggled the past 5 weeks. You can see we're up near 69. Now we're back in the 59s. Even with the earlier bounce today, energy down more than 1%. Specialty retail having a really nice day today, bouncing back, but still below its 20-day moving average. So more technical work to do there. Clothing and accessories is just, I don't even know what the word is here, but this group really has had a rough May. They'd like to start the month over again. But after a huge decline yesterday, and even with a little bit of a bounce today, the group down more than 1%. And the truckers will give them a lift to the downside because the truckers, for the 7th consecutive day, have moved lower. This has just been another area of the market that you want to avoid. As far as some of the individual stocks go, Viva Systems reported another great quarter last night, beating estimates top and bottom line, raising guidance for the next quarter and fiscal year. Viva having another huge day with its earnings report. And Dollar General trying to make a big breakout here. Also another strong earnings report. DG trying to top those highs we saw at the end of April. And then finally, on the flip side, PVH. Want to know why the stock's been going down like this? Well, their warning for the next quarter was the reason. So with their earnings today, heavy volume, big gap down. You can see the stock down about 13% today. When you see these stocks going down, I know the tendency is, oh, well, they're just oversold, but many times they're going down for a reason, and we found out why on PVH earlier with their earnings report. All right, Erin, mixed day today, which is better than I guess we've seen recently. It's been mostly sellers, but not feeling very good after this move up and then kind of selling, moving back toward the flat line.
Yes. Looks like a little bit of consolidation or a pause today. I think there's still a lot of concern out there. The weakness in the market, I mean, I looked at my indicators yesterday and they're really quite ugly, to be honest. So I think best case right now is just going to be more sideways movement, but I think that's best case. I just don't see a rally on the horizon.
Yeah, and, sentiment is something when we start seeing selling, a lot of times, it's not that I turn off the charts, the individual stock charts, because I still want to see relative strength, see what's performing well, what's not. But I do think sentiment really starts to kick in as far as trying to find a bottom when we're selling off. We got the VIX, which today is down, but it is in a clear uptrend. Not quite sure what to make of that, the fact that the VIX has not broken out above the early May high, even though the selling has gone, has taken us to a new low in terms of the S&P. Not quite sure if that's bullish or bearish, but something maybe to watch. And then I also wrote this morning in my blog about the equity-only put-call ratio and the fact that the 5-day moving average now is back above 0.70, which is a high reading and which coincides with a lot of market bottoms over the last year. So I think the sentiment is starting to kick in, the bearishness, and that could be a good thing. But sometimes if you're off by a day or two, it can be pretty pricey. So we'll have to kind of watch for that. But do want to introduce our guest. We have Dan Russo back with us from CHAIKIN Analytics. Dan, always a pleasure to have you. Welcome back.
Tom, thanks for having me. Always a pleasure to be here. Hey, Erin, how are you?
I'm doing just very well.
Good.
Yeah, for some reason, and maybe I'm wrong, but it seems like every time we have you on the show, the market's getting hit to the downside. So
it's so funny. I was on Bloomberg yesterday and I was talking to the host and I was telling her every time I am making some sort of public appearance, I try to work on my presentation or my charts or see what I want to talk about ahead of time. And right up until the time of the appearance, I'm wondering if it's still going to be relevant. Things move. If I'm making a public appearance, you probably want to buy VIX because volatility is going to pick up.
That's
It's
what usually
amazing.
happens when I'm gone. The market
It's
takes-
amazing.
That's pretty funny. It kind of reminds me. I know when I got married back in 1987, I was out of the country, and that was back in when the crash hit. I was married. I don't know, October. Well, I should remember October 10th, and so I was on vacation that whole next week. And of course, that was the week that the crash started, and it escalated on Friday. And then I got back on Sunday, and of course, Monday was the day that the market took this huge tumble. So I was like, wow, that's kind of weird. My portfolio took a massive hit that week.
I remember that week. I actually remember that week well. My dad was in the business, and I remember it because I didn't see him for probably a week and a half. This was pre-technology, right? So the massive amounts of paperwork that they had to deal with. He was a trader, and there was a solid week and a half where I just did not see my father because of the crash.
Wow.
Well, then I had another story in year 2000 when the market topped. It was May 10th or May 12th or whatever. When the 2000 bear market started, I was having my broken nose fixed from playing basketball, and I was completely out when we topped and started coming back down. I'm like, okay, I can't be out of the market. I can't be away from having access to the market ever again. So that's my goal now going forward.
There you go.
But anyway, I know you got a great presentation, so we're going to get the show going here. But if you don't mind sticking around, Dan, we're going to have you back about 12, 13 minutes.
Perfect. Thank you.
All right. Sounds good. Let's go, Erin. Let's get this thing going.
Let us do this. Upcoming schedule. We have Tom's seasonality report tomorrow. Rick Ben Sr. will be with us on Wednesday of next week. Jesse Felder will be here Thursday. And Roman Bogomazov will be with us. He is one of the Mr. Wyckoffs we have here. So it should be a great show. Today's agenda, it's going to be a great show today. Dan Russo, as we just introduced, will be talking with us after our news and headlines. Rosetta Stone, RST, is going to be our first symbol. And talking technically, we're going to be doing that short segment on, well, I think it's going to have something to do with CHAIKIN Analytics, maybe. Our last segment is going to be Under the Radar. So let's go ahead and get started. Technical news and headlines.
All right, let's take a look first at the economic reports out this morning. We did get the Q1 GDP, the second estimate, out this morning. If you recall, when we got the initial estimate out, it was 3.2%. The consensus estimate was for it to drop to 3%, but it only fell to 3.1%. So we did have a little bit of a drop, but we beat estimates. That was probably a good thing. And consumer spending was a big part of that. That was a big reason why the GDP did come in a little higher than expected. Initial jobless claims matched expectations at 215,000. And then at 10 o'clock, we had a pretty nasty miss on April pending home sales. But we did have, it's going to be interesting to see what happens in May, because in April, if you recall, the 10-year Treasury yield was rising. But now in May, we've seen a big drop. And so it'll be interesting to see if maybe we have a turnaround on the pending home sales in May. So that'll be something to watch for next month. But as far as that 10-year Treasury yield goes, we take a look at the chart here. You can see that this downtrend now has been extending for about 7 months. We topped at 3.25%, double top, been coming back down. And for the most part, I've been looking at prior lows, but now I've got to go back. This is a 3-year chart going back into 2016. And you can see that the really big levels now from a more intermediate term perspective are all the way back down around 2.05% to maybe 2.11, 2.12%. And so that, I would suggest, is probably going to be the next move to the downside on the 10-year Treasury yield. Can we hold that level? I did just want to point out that during this downtrend, that PPO on the 10-year Treasury yield has remained in negative territory. And each time we've gotten back to a top, you can see we get to that center line, and then we roll back over. So that more intermediate term momentum is clearly to the downside. What we eventually need to do is get a break above this downtrend line and see that PPO go positive. Until then, I think we got to keep looking below for some support, yield support. All right, as far as the earnings go, we had a number of companies out yesterday and again this morning. Viva Systems, that was a huge report there. 50 cents versus 45. They beat on their top line. They raised guidance for the next quarter's revenues and earnings per share and for the entire year. So this was another really solid report. I can't remember if it was last quarter or the quarter before, but Viva Systems came out with an earnings report. And I said, I think that was the best earnings report I've seen all quarter. Well, this one was right up there as well. This was an excellent earnings report. The market is rewarding the stock. We'll take a look at a chart in just a minute. On the flip side is Palo Alto Networks, which did beat on the bottom line, but the market not impressed. And we have seen a downtrend in this stock. We've seen underperformance, relative underperformance by the stock heading into its earnings report, and the stock getting hit hard today. And there's some others on your screen. Again, I mentioned Dollar General earlier. Nice earnings report there, trying to get a breakout with Dollar General. Do want to mention after the bell, there's some very interesting stocks that are coming out with earnings, especially if you tend to trade stocks outside the Dow. Some pretty big companies there with Costco, VMware, Dell, Alta. Alta all of a sudden can't find support. They're coming out with their earnings after the bell today. That's going to be an interesting development to see what happens with their earnings report. And then OKTA, kind of like Viva Systems in that software space, been a really good performer. I expect another good report with OKTA. And then ZS also reporting after the bell. That's been a pretty good stock. So anyhow, still earnings news coming out. It's not like it was back in the latter half of April and into early May with the hundreds of companies coming out. But we still do have some very influential companies reporting, number of them after the bell today. All right, taking a look at Viva Systems. This is a chart that I think looks great. Continue to believe this is one of the better software stocks out there. Here you can see huge move up. This was the earnings report. Actually, it was maybe 3 quarters ago. That was the earnings report when they got this reaction. Huge volume, just blew the numbers out of the water, top and bottom line, raised guidance. That didn't necessarily mean that we were going up, every day for the next 6 months. But after consolidating those gains, the market fell apart in the fourth quarter. You look at this, you say, wow, it didn't do very well. Relative to the overall market, it held up pretty darn well. I mean, after held on to most of its relative gains. And then when the market started strengthening in 2019, Viva has been one of the better performing stocks. It's in a great group, and it's one of the best stocks within the group, the software space. So I love the breakout here. I think the stock continues to be a stock that you should keep on your watch list for tests. And it does pull back from time to time. You'll get 20-day tests, 50-day tests. Those are opportunities, in my opinion, to trade a stock like Viva. PANW. Taking a look at PANW, look at this move to the downside. Telecommunications group. The group has been struggling since the end of April, like the overall market, but this stock has actually been struggling relative to its peers for 3 months now. So even before the earnings report came out, it was at about a 5 or 6 month low relative to the telecom equipment group. And then they come out with their earnings report. They did beat on the bottom line, but clearly traders not impressed. Stock down 6% today. Huge move down on PANW. One last one that I wanted to bring up here was just Dollar General, showing you this big move up, trying to get a breakout. This is part of the specialty retail group. And after, kind of going along for the ride, I'd say for the last 4 or 5 months, now it is breaking back to the upside relative to its group based on its earnings report. Nice volume today. I think the stock looks great. I mentioned the clothing and accessories index. Take a look at what's going on here. We're not just talking about a group that's been underperforming, but we're talking about a group that's also making a technical breakdown, losing the March low. We did that yesterday, and further selling today is just extending this to the downside. I just want to bring up the relative strength. These are the types of charts that personally I would avoid. When you get a stock like this or a group like this that is underperforming, I tend to look away from the group. And check this out. We had a relative breakout back in April above the February high, but since then we have completely fallen apart. This is one of the hardest hit areas during the recent market weakness. I would avoid this group until it begins to start to show some relative stability first, and then a little bit of strength. But clothing and accessories, not a good group here, Erin. Upgrades, downgrades, what you got for today?
All righty. We do have quite a few upgrades, downgrades that happened today. I picked out the ones that were interesting. Viva Systems that you were just talking about was upgraded today. Not a surprise, is it?
Yeah.
All righty. I'm not going to look at that, though, since we just looked at that. Let's start off with Comcast. Comcast was upgraded today by Guggenheim from a neutral to a buy. I just would not be looking to buy this stock. I suppose we're near the bottom of what could be considered a trading range, and you might be able to get back up there to 44. But I don't like, first of all, that short-term breakdown that happened yesterday. And now if you take this other low that we had back here, we've broken below that as well. And of course, you can see in the thumbnail, there's your 50-day EMA. And today it is, it's traded below that. Got the PMO sell signal. The PMO is actually increasing. It's accelerating lower. So I find it interesting that they upgraded it, but hey, don't always agree. I think it could be interesting if it holds that support. I will say that. All right, Global Payments was upgraded today by Guggenheim as well from a neutral to a buy. It's been in a really nice rising trend channel. It's not too steep. It did break down below it yesterday, but it's right back up trading in it. We did have some really negative volume here, and you can see that on the OBV, how it just sharply took a turn downward on that large negative volume that we had. But you know what? It's managing to keep up with its rising trend. I suspect it can continue that, but watch the OBV. If it gets down below, some of these lows down here, I would start to get a little bit more concerned about Global Payments. YY was actually upgraded yesterday as well as today. Nomura upgraded it today from a neutral to a buy. I like this one a lot better than any of the others, and I could see this being one of those under the radar stocks, to be honest. You've got the PMO is now turning up. Look at the scooter, relative strength starting to improve here amongst its peers. Yeah, OBV doesn't look that great, but given this decline that it was in, that's a pretty sharp declining tops trend line. And the fact that we didn't lose too much off of that, I think is, it's encouraging, I suppose. You can also see the low here is higher than the low we had back here. So I'm feeling okay about that, but you're getting a little bit of a breakout right now in the short term. So I do like that upgrade. All righty, next up is Kinross Gold. I'm going to actually look at two miners today. JP Morgan downgraded both Kinross Gold and NGD, which we'll be looking at shortly, neutral to underweight. Now, honestly, I'm becoming more bullish on gold as the weakness has been increasing in the market. This one, you can see we have the PMO buy signal. It's been in a pretty nice rising trend through May. And, gold itself hasn't been quite so, well, it hasn't performed quite the same way. It's been a little bit up and down. But I like the fact we've got that rising trend channel. So it is on the downgrade list. Notice here, I just want to point out, remember this May rising trend. Look at what we have with New Gold Incorporated. A lot different chart, mostly sideways movement. We dropped down below some very important support here back from October and December. It is managing to trade in a little bit of a range here, but as far as gold miners go, it seems like you could find something better. Even Kinross looked better. All right, Nucor. Two steel companies were downgraded today. Nucor was downgraded by Deutsche Bank from a buy to a hold, and U.S. Steel was downgraded from a hold to a sell. So they're feeling a little bit better about Nucor by moving it to a neutral. It is getting ready to hit some pretty important support back here from December. You could hopefully find some support there. Being downgraded, I don't know, but they're downgrading it only to a neutral. So maybe they're looking for that $49 level to hold. But accelerating PMO in negative territory. It hasn't started to turn up yet. Would be interesting if it did. But look at the OBV during this particular drop. It's now the low is down below the lows we've seen since August, really. It's about the same there. So, obviously not looking too good there. But in terms of the steel group, when you're looking at the two, Notice that U.S. Steel has already managed to drop below its December low. So it's certainly not the best area to be in. Materials has really been, a dog as far as a sector goes. And it doesn't look like there's much, improvement coming up on the horizon. That's all I had for upgrades, downgrades. So here is the summary slide. And of course, I'll have this up in the Market Watchers Live recap. So just go to the articles tab and you will find the Market Watchers Live recaps right there. All right, time to bring Dan back in. Are you all ready to go? Can't wait to hear what you're going to be talking about today. And everybody do take the poll, because we'll probably talk about that when Dan's done.
Yeah, I'd love to. I love seeing the results of the poll. It's always a good opportunity to poll the crowd. I never miss a chance to poll the crowd, get a sense for what people are thinking. And you should be able to see my screen now.
Yes.
Perfect. So we're going to talk about how to position in an uncertain market, and it certainly seems like the only certainty out there is that the market direction is uncertain, and it's really been the case since we made that top back in January of 2018. It's kind of interesting to me that with all the attention on the 200-day moving average, that not a lot of people really point out the fact that the 200-day moving average is flat, right? We've essentially gone nowhere for about a year and a half. So that's kind of interesting to me. So, we're going to start by just kind of looking at the state of the market and what I think looks interesting right now. From there, we'll introduce the CHAIKIN Power Gauge and how it leads to the relative strength and weakness in the market. And then we'll kind of highlight two areas that I like right now and two areas that I dislike right now. And Tom stole a little bit of my thunder with the dislike areas, but that's okay. We'll dig into them. We'll dig into them a little bit further and kind of see how I see them. First, just a quick disclaimer. We are not registered as a broker-dealer, and nothing I say here should be considered investment advice. A little bit of background on myself. I've been on the street for 19 years. I'm a former New York Stock Exchange market maker, and I actually started working down on the floor of the New York Stock Exchange when I was 16 years old. Fortunate enough to be given that opportunity, and it was a lot of fun, and I really enjoyed it. Currently, I am a chartered market technician, so that means that I passed all 3 levels of the CMT exam to earn the right to use the designation of chartered market technician. From there, I was asked to be the chairman of the New York chapter of the CMT Association, which was a huge honor to me, and kind of puts me in contact every day to day with a lot of really, really smart people, some of whom you have on this show from time to time. I know you have Dave Keller on from time to time. Dave is a friend who I met through the CMT Association. So prior to joining CHAIKIN Analytics about 10 years ago, about a year and a half ago, rather, I spent 10 years covering large institutional investors who I'm still in contact with a lot of them today. So the large mutual funds and hedge funds and pension funds around the country, a lot of names that you would recognize if you saw them, are friends of mine and former clients. So great opportunity for me to kind of be in contact with some really smart people who are running large amounts of money on a daily basis. I'm a frequent guest on Bloomberg TV. As I said, I was there last night, and I always like to use that action shot of myself calling for the market to go higher from 27, 26, which it did. And most recently, something else that I'm really proud of is I was asked to take over teaching the technical analysis class at Baruch College in New York City. So that's been a fun new learning experience for me that I've really enjoyed. And I can honestly say after half of one semester, I'm excited for summer break. I get where teachers come from, and I feel bad for what I put my teachers through. So just a quick I know we rolled the poll out there, and what I'm wondering as we hit the crowd is, will the S&P 500 break below the 200-day moving average within the next week? And I know that is the poll question, so I'd love to see the results from that or hear the results from that.
Oh, did we lose the sound here for Dan? We can't hear you.
Can you hear me now? I was waiting I was wondering if somebody might pop the results up. I apologize.
Oh, no, we're going to wait. We got to give everybody time to answer.
Got you. Okay. Well, that's the question, and I'd love to hear it. So for me right now, the S&P 500 is consolidating, but with bearish momentum. Here's a chart, just going back a year, the S&P 500, there's that flat 200-day moving average, and this does not incorporate today's activity. I put these slides together last night after the market closed, but flat 200-day moving average. We tested it yesterday. For me, To really get bullish, I need to see a break in the near-term downtrend with a move back above 28.50 and ultimately a move through 29.50 for the uptrend to really be reasserting itself. And I do think that if the 200-day moving average does give way, we have to start thinking about 27.20 to the downside. That's actually a 38% retracement of the move from the December lows to the May highs. And from there, I think you want to think about 26.50. That's a 50% retracement of the same move. And what's interesting to me, as I'll show you in a little while, is it's just more than just the chart activity that's driving that view. The CHAIKIN Power Gauge, which I will introduce in a little bit, ranks all the stocks in the S&P 500. And coming into yesterday, for the first time in a while, there were actually more bearish stocks than bullish stocks within our model. But we'll dig into that in a little bit. Here's that RSI. This is what I mean when I'm talking about bearish momentum. RSI is broken below 50, and on subsequent rallies has not been able to get back above that 50 level. Looks to me like momentum is shifting to the downside. So similar to Tom, to what you were talking about with the PPO on the TNX, I'm seeing a similar dynamic starting to take shape for the S&P 500, and then ever so slightly CHAIKIN money flow dipped into negative territory with the move down yesterday. Small caps continue to underperform. We've been pretty bearish on small caps relative to large caps for a while. What we're looking at here is the chart of the IWM relative to the SPY. Clear downtrend below the 200-day moving average. Similar dynamic for momentum. Seems to have shifted into bearish ranges, and all the while there's this strong resistance level for IWM on an absolute basis. And it's just kind of interesting to note that while the S&P 500 was tagging new highs on May 1st, IWM was nowhere close. So we continue to favor large caps over small caps. And again, more bearish stocks than bullish stocks in the IWM. So another just kind of sign of potential weakness going further. We do prefer growth over value. Last time I was on here, I went through my thesis on, in a slowing growth environment, investors are likely to pay a premium for growth. And I highlighted IVW as a way to take advantage of that. So what we're looking at here is IVW. This is the iShares S&P 500 growth ETF relative to the S&P 500, and clear outperformance above the rising 200-day moving average. And now we've broken out of this consolidation. All the while, complete opposite here for momentum. Momentum staying solidly in bullish ranges. So I think growth likely to continue to outperform. So as you're kind of walking through ideas, one of the areas of the market where you want to be considering long ideas or stocks to add to the portfolio are those from the quote unquote growth area. And what I watch closely are semiconductors, especially semiconductors on a relative basis. This is the SOX relative to the SPY. And yesterday was the SOX actually outperformed in a down tape yesterday, and the semis are outperforming today. To me, this is my tell for the market. If this relationship can stabilize at this support level, and it is oversold for the time being, I think the S&P 500 can find support at the 200-day moving average and turn higher. If semis continue to break down relative to the market, and I have reason to believe that they could, because if I look at the stocks again through the lens of our model at CHAIKIN Analytics, there are more bearish stocks than bullish stocks. To the extent that they break down on a relative basis, I think we could see more weakness for the S&P 500. But really right now, semis are what's driving my view. If they break down, I think the odds increase that the S&P 500 will break its 200-day moving average. Yields remain the big story. Tom, you showed a great chart. I'm kind of just being a little redundant here with this one again, though. The other part of the thesis the last time I was here was in a slowing growth environment, central banks would find it hard to raise rates, and the path of least resistance for yields is likely lower, and that would lead investors to favor yield products, either treasury ETFs or yield plays within the equity market. And what we've seen is real estate outperforming, utilities outperforming. Here's TNX heading down. Tom, I have the same level highlighted that you did. And, I use RSI as my gauge of momentum. So your PPO and my RSI line up just solidly within bearish ranges. So to me, I still think the path of least resistance is lower for yields. Wouldn't be surprised if we traded down to the 2% to the 2.1% level.
Hey, Dan.
Yes.
I got a question for you on that. If you go back to that chart, I ask all our guests the same question. I keep trying to find somebody that agrees with me. So
when people disagree with you, I find that that's better.
Oh, well, okay.
But I always disagree with you.
That's good. I guess that's good then.
Well, it just kind of gets back to sentiment and consent. Like, you don't want to be consensus, right?
Right. No, that's true. You don't want to be within the masses. But the point I was making is, while the 10-year Treasury yield's been going down, and I usually use that as a gauge of what the bond market views about our economy. But it can also have an inflation or deflation component in it. And I see today the UUP, which is a dollar index bullish fund, is threatening another breakout to the upside. That rising dollar continues to pressure commodities.
Yep.
Prices. And so another possibility that I'm going to still cling to, whether I can get anybody to agree with me or not, is that the rates falling, while, yes, I think part of it is the fact that we could see economic weakness ahead, or at least not as much growth as we were earlier forecasting. But I think it's also a message that the bond market is sending to the Fed that don't forget about deflation. I mean, we're not up to their inflation targets. We've been coming in light. And in the Fed's last statement, they said that they thought the lower inflation was transitory, that, in other words, it was going to all of a sudden move back up. But when you look at commodity prices and you see oil going down and you see, copper prices dropping and so forth, silver, how are we going to have inflation going back, up to create this inflation that the Fed's talking about? I'm seeing the opposite. And I'm just wondering, when you look at this 10-year Treasury yield dropping from 325 to 225, I mean, it's a full point.
Yeah, it's unbelievable. And, I actually think you are looking at it the right way. And I think that there's almost this kind of vicious feedback loop, right? But for me, it actually starts with rates in global developed markets, right? So even at 2.23% as of last night's close, our 10-year looks really good relative to the rest of the global developed markets, right? When you consider Japan and Germany are negative on the 10-year, right? Australia is below 2%. The UK is below 2%. We look really good to global investors searching for yield. So here's the loop, right? Our yields on a relative basis are higher than the rest of the world. Buy dollars to buy treasuries, right?
Yep.
Forces the dollar higher, forces yields lower, forces commodities lower, and then repeat, right? Rinse and repeat.
But is this going to be
we have this, we're kind of the best house in town from a yield standpoint. So if you're a foreign investor, you're going to come here searching for yields. I think that continues to put upward pressure on our dollar, downward pressure on our yields, and the rising dollar impacts commodities. So I'm in agreement with you. We might not get there exactly the same way, but I am in agreement with you.
But doesn't the Fed need to lower rates to weaken the dollar to stop this spiral?
It could be that, Fed game theory on the Fed is above my pay grade. I wish I don't have a good read there based on my process. I'm just kind of seeing the trends that are in place. The bond market's certainly telling you that they think that's the case. I mean, I think, the Fed funds futures market is now pricing in a full rate cut by the end of this year and potentially one or two more next year. So I think people are starting to get into that camp in the futures market. So
yeah,
it does seem that there are people who do agree with you, Tom.
All right. Well, you just agreed with me. So Gretchen, Zach, we need to schedule to get Dan back on more frequently.
So one of the ways that we've liked to play the falling rates is through the IEF. This is the iShares 7 to 10 year Treasury bond ETF. Just nice steady uptrend, and the scooter at the bottom kind of tells you the whole picture. For those of you who've heard me present here before, the importance that I place on relative strength. Scooter, great way to see that within StockCharts.com. And well, I think we're probably a little bit overdone here in the near term. This is a solid trend that's likely to continue. And for those of you who want to express the view in the equity markets, we're going to look at that in a minute. But kind of for us, the key mantra for us and what drives everything we do is that actually fundamentals drive the market. We can talk about sentiment. We can talk about anything you want. But at the end of the day, longer term, bigger picture, fundamentals drive the market. And it's our emotions and our sentiments in the shorter term that drive the market to extremes. And what we believe is that combining fundamentals and technicals is the best way to outperform the market. And wherever possible, we want to take emotions out of the equation. And the way that we do that is with the CHAIKIN Power Gauge. Powerful tool, your GPS for the market, combines fundamentals. It's actually 85% fundamental, which a lot of people are surprised by when they consider Mark Chaikin created it. He's well known as a technician. Many of you probably use his indicators. I'm a CMT, and I firmly believe this. Fundamentals drive the market. I love using a fundamental model in conjunction with technicals to try to give our clients an edge in the marketplace and really level the playing field when it comes to competing in the market. So it's an unbiased model. It's completely unemotional. Looks at financials. That's the value type metrics folks like Warren Buffett look at. It looks at earnings, so the things that your growth and momentum type investors look at. Obviously, there is a technicals component to it, in particular, relative strength and Chaikin money flow being two keys there. And then our kind of secret sauce is experts, right? We are looking at what the market participants are seeing and doing. So we look at what analysts are doing with their estimates. We look at what analysts are doing with their ratings. We look at what the insiders are doing, and we look at what the short sellers are doing, and we roll all that up every night into a rating on over 4,000 U.S. listed equities that runs from either very bullish to very bearish, knowing that our bullish and very bullish stocks tend to outperform the market. And the reason we like models is because I've stolen this quote from Jim O'Shaughnessy, a famous and very successful quantitative analyst and investment portfolio manager. Models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. And we've all been there. You all know how you felt on December 23rd or December 24th as the market was plumbing towards those 2350 lows. It's scary. Your emotions can get in the way, and we try to eliminate it as much as possible. And I underline that word because I really do think it's important. So the way that we find relative strength in the market is driven, everything we do is driven by the power gauge and the power gauge rating. What we can do very quickly is start to look at the sectors of the market that have more bullishly ranked stocks than bearish stocks, right? So if we look at financials, 27 bulls to 1 bear, right? Utilities, here's your defensive posture. Utilities, healthcare, right? 8 bullish or very bullish stocks, and utilities for only 2 bearish stocks, and so on and so forth. And then, Tom, you mentioned materials and energy. They've actually been 2 of my least favorite areas of the market. And here's why. They've perpetually both been at the bottom of this list for months now. And we'll take a look at a really interesting chart that takes it a step further as it relates to energy. And we can kind of drill down. Once we've identified strong sectors, we could drill down to the industry level at the same thing. The power gauge rating drives everything we do. My views on the insurance industry don't come into play. Power gauge rating tells me that insurance has 30 bullish stocks and 2 bearish stocks. I want to be looking for long ideas in insurance. At the same time, oil and gas, equipment, transports, I want to be avoiding that area of the market. Regardless of my feelings on the groups, I let the power gauge rating drive the way. So real estate is a market leader. IYR is a U.S. real estate ETF. And you can see here, this is our measure of relative strength. It's been outperforming the market for quite some time and recently started to do so again. So real estate is an area of the market, again, plays on that decline in rates. Real estate is an area of the market where we have been doing some good hunting for long ideas and been successful for our clients for the most part. Recent very bullish idea, very bullish meaning that's its rating at Chaikin Analytics. American Home for Rent, AMH, nice steady uptrend with bullish money flow, persistently bullish money flow really since the beginning of the year, and Scooter in a nice uptrend. But it's the power gauge rating that tells me that all of this is likely to continue. So American Home for Rent is not a name that's on a lot of people's radar screens. Another aspect of kind of taking your emotions out of the equations, it opens you up to find new ideas. I found this one recently, and it looks good, and I think it continues to look good. I do like tech, but I like playing tech right now, just given a lot of the volatility in the marketplace. I like playing it through the real estate lens. Equinix, EQIX, is a bullish stock at Chaikin Analytics, and they basically own the buildings and the property where a lot of the big companies store their equipment, their servers. So it's a play on tech with a real estate bent to it. Nice steady uptrend above the 200-day moving average. Bullish rating at Chaikin Analytics. Here's that Scooter score, up at around 95.5, likely to persist going forward as the fundamentals and technicals here look good. Financials, I showed you, are at the top of the list. So the fundamentals for financials are bullish. But what's interesting to me and why I place so much importance on relative strength is despite the bullish fundamentals, and this is why the combination of fundamentals and technicals is also important, financials as a broad group haven't really shown us much in the way of relative performance. We've had to dig below the surface. So we talked about insurance. Look at the relative performance for insurance here based on our relative strength metric. KIE is the insurance ETF. It has a very bullish ETF rating at CHAIKIN Analytics. Nice uptrend, bullish CHAIKIN money flow, just likely to continue to outperform the market. It's an area where we want to go hunting for long ideas, stocks that have bullish or very bullish ratings. So Metlife looks interesting to me as it consolidates and holds above support. Scooter moving in the right direction, so we have the relative strength. CHAIKIN money flow is green, telling us that institutional investors are accumulating the stock, and it has a very bullish rating within our model. So Metlife, name that looks compelling to me in the here and now. I actually made it my bullish stock of the day earlier this week. Another name that looks compelling, more so because of the model and what I think is likely to happen. Allstate, right? Consolidating here, but it does have a very bullish CHAIKIN power gauge rating. And what we can see from the scooter is it's broken this downtrend line and is beginning to outperform the market as money flow starts to get bullish. We're holding above that flat 200-day moving average, but I think that this is a stock that's likely to continue to outperform the market, because we're starting to see it in the relative strength, and our model is very bullish. So that is another name that I would focus on the long side. Now, Tom, you mentioned energy. Energy is a name that we've been bearish on, or an area of the market that we've been bearish on. It has a bearish ETF rating. This is the XLE, but I want you to focus in on this box right here, because this is our measure of relative strength, and it has been a persistent and intense underperformer since December. And the reason I'm highlighting December is because look at what started to happen in December. This is that crude chart. So even as crude rallied from the 42, 43 level up to the 66, 67 mark from the lows in December, the oil stocks were not having any part of that rally. And the entire time, we were, for the most part, we're bearish on the group in our fundamental and technical model. Right. So that's kind of interesting to me. I was getting so many questions. Dan, why are you so negative on energy? Oil's rallying. Because the model tells me to be negative on energy. And it worked out. We were able to identify names like Concho with a very bearish rating. This was my bearish pick of the day a week ago today. So if you sold the open on my pick of the week, you have done pretty well. Very bearish stock. Look at this scooter, massively underperforming the market. Institutions cannot sell it fast enough. Persistently bearish. Money flow, another name that's just been a constant to avoid, right? You talked about bottom fishing, Tom. A lot of people like to go bottom fishing and beaten down names. Halliburton has been bearish in our model for roughly a year. And even as it tried to pick up its head with oil, we stayed bearish. Stock was continuously underperforming the market. And now look what's happened recently. These stocks could not do well while oil was rallying, and now oil is rolling over. And they're completely breaking down. So Halliburton is a name that we've been able to identify on the bearish side of the portfolio as well. And Tom, you spent a lot of time talking about retail. I think retail is weak and getting weaker. I think what's happening here is investors are starting to price in the potential margin impacts of tariffs. But that's just my view, and that's my opinion. What drives my thoughts, though, is the bearish rating on the retail ETF. Look at this. 39 bearish or very bearish stocks in our model, only 6 bullish or very bullish stocks. Persistently underperforming. It's not new. It's not because of the tariffs that retail is all of a sudden falling out of bed. It's been underperforming since November. The intensity is just starting to pick up now with the tariff concerns, right? So we're very bearish on a name that looks like it's just starting to roll over. Advanced Auto Parts, and kind of interesting to me, we've lost the 200-day moving average. Rally attempt failed, and we are heading back down. Again, very bearish rating within our model. Scooter telling you that the relative strength is no longer there. We're heading in the wrong direction. This looks like a compelling name to avoid, or if you do play to the bearish side, to look for opportunities to open bearish positions in advanced auto parts. And this has been a market darling for some time. So as the crowd starts to see what's going on here, we want to get you out in front of it. Another one that was interesting to me, and I'm kind of cherry picking this one a little bit, but it's with good reason. Gap, right, was in a tailspin, and they throw the Hail Mary pass. They're going to spin out Old Navy, and the stock rips. And everybody starts to get excited because this is, going to change the company and unlock Old Navy's profitability. All the while, our model stayed bearish. Told you our model was not buying the special situation, right? And the stock has done nothing but head lower ever since, underperforming the market with massively bearish money flow for the most part. So think what you want about Old Navy, the Gap, Banana Republic, anything else. The model told you to stay bearish, so we did. So that's it. The CHAIKIN Power Gauge drives everything that we do. It really does help you kind of navigate, survive, and thrive despite no matter what the market's doing. And we're really excited because we just rolled out a new product. It's called the Market Survival Guide. It's a weekly note plus actionable alerts, comes out every Tuesday morning, where I kind of look at the market similarly to the way I did here, across asset classes, what's outperforming, what's underperforming, where can you find opportunities regardless of what the market's doing. And we normally sell this for $49.99 a month, but I told the team that I was coming on the show that I wanted to give you guys a great deal. So we are knocking it down to the lowest price per month that you're likely to see it, $29.99 a month. As I said, weekly newsletter comes out every Tuesday. One of the best reads out there today. It's clear and to the point with a well thought out process that you can easily understand. This is recent feedback that we received. We just launched this product 2 months ago, and you'll get intra-week alerts. We host a weekly call every Wednesday afternoon. We host an hour and a half, 2-hour call, myself and one of my coworkers going through our thoughts on the market, taking everybody's questions. So again, if you head over to chaikinanalytics.com/guide, you can grab this product for the lowest price per month you're likely to see it. And if you're not happy, we have a 30-day money-back guarantee. We're happy to cancel you out at any time. So that's my current views on the market.
All right. Well, there are some questions in the room.
I love questions.
Yeah. And I'm going to kind of summarize the questions because there was a number talking about basically directional. What do you think the overall market is going to be doing? And I'm talking about, not only short term, you're looking at the 200-day moving average. And that, of course, that's a question in the poll. Make sure everybody takes that. If you don't mind, we're going to talk about that in just a minute. But even going out a few months, questions are out there as to what your take is as we go into these summer months, which typically, can be a little bit difficult for the market. I mean, historically, the summertime we see not quite as good a performance as we do other times of the year. So just a, quick summary, what are you all thinking about the market here? I mean, do you think that we do break down and go down to that 26 and change to get that?
I think that if we continue to see a deterioration in our model. So if we continue to see the ratio of bearish stocks to bullish stocks within our model continue to grow, i.e. more bearish than bullish stocks, to me that increases the odds because it's forward looking and it looks at the stock level. Remember, it's a market of stocks, right? Ultimately, it's the stocks that drive the index, and you're going to see individual stocks will start to break down before the actual index does, right? We're starting to see it in small caps. We're starting to see it in semiconductors, right? Everybody loves to talk about the market. And the point that I would make is I think we're choppy at best in a broad range over the next 3 months. I think that if we do see that deterioration in our model and a break of the 200-day moving average, I do think 2650 is a very real possibility. At the same time, we could just as easily start to reverse and head back up towards 2900. So what I think is, I think we could be in for some choppy trading, which is why it's going to be important to go below the surface, because within that choppy trading, you're going to be able to find the relative strength. I've been on here. I've talked about the importance of relative strength. I mean, Tom, you called it out with Vive, right? That when the market was cratering in December, Viva Systems held up, right? Kind of went sideways. And then what happened? As the market started to rebound, it was a massive outperformer. I think you're going to be able to look below the surface to the sector and industry level. And regardless of the chop in the market, you're going to find areas of outperformance, and that's where you should focus your long ideas. And you're going to find areas of underperformance, and that's where you should focus on your bearish ideas, or just avoid those areas of the market completely. So I think odds favor choppy trading. And this is dynamic, right? We kind of think of, we view the market in a Bayesian way, right? Every time we get new information, we update our probabilities, right? If you ask me on Friday, there were more bullish stocks than bearish stocks on the S&P 500 in our model. So if you ask me on Friday, do you think the 200-day is going to hold? I would have more confidence. I'd say, yeah, that's a higher probability event that it's going to hold. Ask me today, when there's more bearish stocks than bullish stocks, I think the odds of us breaking down just went up. So we adjust every day.
Yeah. Well, I do have one chart I'm going to bring up before we go into the poll, if you don't mind. And you talked about energy and materials. And I just wanted to show this chart because this is a 20-year weekly chart. So on the top is the XLE versus the S&P 500. And on the bottom is the US dollar index. And for somebody who's, has questions about energy and materials and why don't you like this group and so forth, first of all, I completely agree with your analysis. I mean, energy, materials, I think that they should just completely be ignored. I don't like the groups. And I think there's going to need to be a change in the overall trend of the dollar before I would change that stance. If you look back at the last bull market we had from 2002 to 2007, we had a declining dollar. And as a result, energy was a leader in that bull. But once we made this huge move in the US dollar, breaking this downtrend, I don't think there's any question that downtrend had ended when we had this huge move. Look at the relative strength breakdown across multiple years, relative support, and we lost that. And we have been downtrending while we continue to uptrend. And one of the things that really that caught my eye is even when the dollar went through that period of decline, still there was no money rotating into energy. So I think that speaks volumes. I think as long as the dollar continues moving up, I think energy and materials on a relative basis are going to underperform. And if you're trying to outperform the S&P 500, the more money you have in underperforming areas, the more difficult it is to outperform the benchmark. So I'm avoiding the two areas. I do believe that if the Fed does begin to lower rates, the Fed's, being kind of stubborn like they were at the end of 2018, saying, that this is transitory, no problem. Inflation's going to come back up. I don't think it's going to. And I think the Fed is going to do exactly what they did in December, which is crater to the market. And they're going to come back and lower rates. And when they lower rates, let's see what happens to the dollar, because it is our rates versus global rates. It's not just what's going on here in the U.S. But if we do start to drop rates and the dollar begins to fall, then I think energy and materials could be something to consider.
Yeah, and that gets into that again, gets back into the dynamics, right? You're looking at probabilities right now. Odds favor rates going lower, dollar going higher. We want to avoid energy. We want to avoid materials. I showed you how within our model they are the two weakest sectors of the market as it relates to percentage of bullish stocks and bearish stocks within each sector. But of course, if something changed, you have to adjust your probabilities. And what I suspect is you'd actually start to see the stocks move before that.
Yep. All right. Well, we're going to go into the poll because I know you're anxious to see what
I love the poll.
Audience thinks about the 200-day. And I mean, we're almost right on the 200-day. So I would have expected a high response on the yes side. So I'm not.
Yeah, but 3-1, huh? 76% say yes, 24% say no.
So what do you think? You think we go down first and then bounce?
I think that the odds of us breaking have increased based on what I'm seeing in our model. And should we break the 200-day moving average and kind of close below it, I think it's a very real possibility that we could go to 2650. 27. I don't think we go there in a straight line. I think you want to think about 2720 and then through there 2650. But to me, it's contingent on two things. Semis continuing to be weak, which leads to the S&P 500 breaking the 200-day moving average.
Yeah. I'm going to say no. I'm going with the minority. I don't believe we're going to break it to the downside. I think
The problem, it's almost too obvious, right?
Yeah.
Everybody's watching this and everybody's waiting. So it's almost too obvious. That's kind of what it feels like to me, right? I mean, we've been doing this a long time. The market wants to make, the market's sole job is to inflict the greatest amount of pain on the greatest amount of participants at any given time. So if everybody's kind of getting short in anticipation of the break, we're not going to break.
Well, here's where I'm coming from. And Erin, I want to get your thoughts too. But the reason I'm saying no is that historically we're at the end of May heading into June. Normally money flow coming into the market beginning of the month. We have portfolio managers a position, ahead of that money coming in. Historically, and I've said this going into this week, from May 26th to June 5th is one of the most bullish historical periods of the year. So I think over the next week, I don't think we're going to do it. I believe we're going to bounce as we go into the beginning of June. After that, I don't know.
No, it's kind of interesting. And seasonals don't drive what I do, but obviously I pay attention to them. And, the selling may go away for all its criticisms, and it has its fans as well. And it's kind of worked this year. But historically, it's those latter 3 months of sell and may go away that are the weakest.
No doubt.
You generally get some bullishness in July as we get through earnings season. And it's kind of really August, September, October that are the weaker half of that weaker 6-month period.
Right. I agree. Erin, before we go, what do you think? What
do you think that I would do?
Yes.
I did say yes. But, I'm looking at my models, my own, indicators, and they're so weak. I'm seeing a possible head and shoulders. I mean, Larry Williams, I'm sure you know him, Dan.
Of course.
He was on the show yesterday, and he's looking at 2,700. So,
realistically,
I just don't see enough good stuff going on. I don't think we're going to break down, honestly, much below 27.25. I don't think it's going to be super painful. I don't think the head and shoulders I'm seeing is going to actually activate and get us down to the target, which would be right around that 2,600 level. I'm not.
Yeah. And then 27. So 27.25, 27.20 is a 38.2% retracement of the move off from the December low to the May 1st high. Like perfectly normal.
Right.
Perfectly normal. Even 2650. 2650 would be a 50% retracement, and it would be roughly 10% off the highs.
Right.
Perfectly normal. Everybody will freak out.
Right.
But perfectly normal.
Yeah, it'll be interesting to see. I can't get that bearish. I mean, by the time we move to that level, I'll be interested to see my indicators. They'll probably be pretty oversold. So
I would think so.
Yeah.
All right, we got to run, Dan, but it's always a pleasure having you on here. And
always great being here.
Because you agreed with me today, you're the first one to agree with me. So we're going to bring you back tomorrow and Sunday.
Every day.
No problem. No, it really is a pleasure having you on here. Great information. Always love to hear from you. So
I love being here. Thank you.
All right. Appreciate it.
Have a great day, everyone.
Yes. Yeah. Erin, it is time. Let's move on. We got the 10 and 10. So let's go ahead and jump in.
Yes, let us do that.
I'm going to go ahead and go ahead with the RRG.
Yeah, there it is. So really interesting software, semiconductors, and then look at our comm services, all internet stocks. So I thought that was pretty interesting. And as far as our movement goes, a lot of greens today, a lot of greens. All right, go for it. Let's start with RST, Rosetta Stone.
All right, RST, first of all, I think it's holding support. I think the support has been pretty firmly established. After all this buying, finally the sellers kicked in around 23.5, took us back to the 20-day moving average, and then we broke out again and up to the upside. Notice this pullback about a week ago when we had this big hollow candle. We did go down and test 23.5. We bounced over 25, and now here we come back down again. I would watch this key area of support. Now, this is a stock that's been very volatile relative to its peers in software, but right now it is trending higher. I think as long as it holds 23.5, I'm bullish. If it breaks below, I'd be watching the volume because you can see a lot of red volume bars here, which makes me a little nervous, but we haven't lost support. So if we lose 23.5, the volume picks up, my opinion would change. But for now, I would be bullish RST.
Okay. The most popular in the chat room is Applied Materials, AMAT.
Yeah, you know, AMAT on a relative basis to its peers, and this is one that I probably could have included in like under the radar, because the stock's going down, the group's been horrible. So who wants to own Applied Materials? Well, starting to show some nice relative strength, breaking out to about 9-month relative highs. And so if this group moves higher, I wouldn't be surprised to see Applied Materials regain a significant leadership role here. So I actually like the stock. I'm watching the area of support just above $38. You could go back down to the low in March around 36.5, 36.75. But I think this is an important area. I think as long as that holds, I think Applied Materials looks really good relative to its peers. So I'm actually a little bullish Applied Materials here.
All right. Next one, I think you've probably heard of it, Facebook.
Yeah, I know. Uh-oh. Did I just go? Oh, there we go. All right, let's take a look at Facebook. Now, this is, let's see here. Try this again. Facebook, this is giving away a little thunder because when we go into under the radar, this is actually one of the stocks I had for under the radar. So I'm giving you a little bit of insight into the final segment. But I like the fact that this stock is holding right around 180. You got the 50-day moving average coming in after it gapped up in April. All the selling that we've seen has taken Facebook back down about 10%. But volume's been light. And on a relative basis, don't ignore Facebook relative to its peers moving higher relative to the S&P 500 near about a 10-month high. And the group overall actually still in an uptrend versus the S&P. So I like Facebook. I think this one goes higher.
Okay. Next one up is RLI Corp. It is property casualty insurance, RLI.
All right, RLI. Not sure why it wants to keep trying to log me out here. Let's see, the move up here, very, very nice volume, negative divergence. So what I'm going to annotate here is just I would be a little cautious because as we continue to move higher here, you can see that we are moving lower on the PPO. And also notice the volume has drifted much lower as well. So that would just be a warning sign for me. I'd be a little careful here with RLI.
Okay, next one up is our only industrial request, Triton International, TRTN.
All right, TRTN. Well, I think it's pretty clear that we have a line in the sand on TRTN. We had a huge sell-off here we held, huge sell-off here we held. This is where the buyers come in. Close below $30. This one's easy for me. Close below 30 and I'm out of the stock.
All righty. Next one up is Darden Restaurants, DRI.
All right, DRI. Okay, first of all, Restaurant Group's been pretty solid. So I'm okay with this. I know the stock's pulled back over the last week or so, but this has been a really good performer. When the market was pulling back throughout May, we actually had a breakout in Darden Restaurants. Now we're pulling back. Volume has been heavy, though, so I really want to watch this support level around 113.
Okay. Next one up is Snap. Oh, Snap.
Oh, here go all of my stocks that I've got in the under the radar. Snap is actually moving higher while the market is moving down. I think that is a great sign, and I believe if we get a move back up shortly in the market, look at the volume coming back in, too, on the way back up. I think Snap's preparing to break out again. I think this is a little bit of sideways consolidation off of an uptrend. I think you're going to break out above $12.50, and I think that measures up to about $15.
Oh, my goodness. Okay, the next one, it's a lower volume stock, but a pharmaceutical, Opient Pharmaceuticals, OPNT.
All right, OPNT. Well, the volume's coming in, but I do have to mention volume is extremely light on this stock. Some days it looks like maybe it's 1,000 shares. I mean, today it's traded 89,000, so the volume has been very heavy. Something maybe they've come out with an announcement, but a lot of manipulation can take place with a stock that trades this few of shares. So, that combined with his overall downtrend, I don't know. I'm not really liking it. You do have a positive divergence, higher PPO with lower price, but seriously, that liquidity or lack of liquidity is probably going to keep me out of the stock, not to mention the overall downtrend that we've had since early March.
Okay, next one up is Shopify. I just got a PMO sell signal on this one, so it's suggesting we're overbought.
I love Shopify. It's one of my favorite stocks. I will say it's in the model portfolio that I announced a couple weeks ago over at Earnings Beats. I think it does have a negative divergence, higher prices, lower PPO, but volume has not been light. This last move up where the negative divergence was created, that's 3 white soldiers, which is a very bullish candlestick pattern with heavy volume. I think there's accumulation taking place. And you can always have pullbacks. The stock, was overbought beginning of May. We've seen the RSI kind of drop off here a little bit, but I believe this is one of the best stocks in one of the best areas of the market. I think your couple key areas to watch for on any pullback, I'm going to say 245 up to about 265. I think that would be a steal if you could get it in that price range.
All right, next one up is Broadcom, AVGO, and the final one.
All right, AVGO. All right, I can just circle this volume down here, right here. I mean, it's not just going down. It's going down with a lot of sellers, a lot of distribution. So I think you got to be careful when you lose a major support. Here was a big gap up, heavy volume. We kept going higher. We look at this gap down below and look at the volume on that gap down. I think this is a stock to avoid. We are oversold. If I was in it and we got to bounce back up into the 270s, I would be a seller and look for something that's a leader, because AVGO has completely turned. I am not a fan here.
Okay, let's see next one. Well, we don't have a next one. That was the last one. Here's the list of the symbols we just went over, and I will have these up in the Market Watchers live chart list. So just go ahead and look for that at the end of the show. And looks like right now, today's Talking Technically. Today, we're going to feature our very own Greg Schnell. He's going to be discussing a pretty relevant topic for today, given Dan Russo was here from CHAIKIN Analytics. He will be talking to us about CHAIKIN money flow.
In this sequence, I want to talk about the CHAIKIN money flow. CHAIKIN money flow uses volume and price, whether positive or negative, to figure out if money's starting to move towards a stock or not. And the idea behind the money flow is just, it's bigger picture. It's not so much day by day, but it's kind of the trend change that you see in CHAIKIN money flow. So in this example here, I've got a stock with some ups and downs in it. And you can see on a daily basis, I don't find the money flow as helpful. But if I switch it to weekly, by just changing the parameters, what you could see is the CHAIKIN money flow was positive. It went negative for a long period of time, and then all of a sudden started to turn up. And at that point on this weekly chart, this was also a nice place to look for an entry. And in general, the price is almost 50% higher with positive CHAIKIN money flow. So the idea behind it is, it's a very simple graphic. Is it going negative, or is it starting to revert to positive? And when you see that changeover, it's pretty good. Now, it does have one simple setting, and that is the number of periods you want to take into account. And you can change it and just get a feel for whether or not it's actually a timely signal. So in this case, the signal starting to go positive over here in April. That's long after the low. So I would suggest that the 20 period was more timely, and we'll just go back and change that, and you can see the difference in how the money flow reacted. So it got you out on a timelier fashion back in here and got you back into the stock as it started to rise again. So play with the parameters a little bit, but for the most part, what you want to see on a stock is positive money flow moving into it, and the CHAIKIN money flow is a good way to find that.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.
Time for our final market update. Let's go ahead and see what has been going on while we've been having so much fun. As you can see, market's really traveling mostly sideways today. Seems a little tentative. Dow Jones is up just over 60 points. S&P up just a little over 8 points. NASDAQ currently is up 0.28%. And we can see that New York Stock Exchange in general at this point is up 0.19%. Russell 2000. Actually, I want to make sure that I got this completely up to date here. There we go. Russell 2000, we can see, is mostly unchanged currently, down just 0.05%. TSX also traveling, consolidating sideways, but on the negative side. TNX, Treasury yields are up just slightly today, reading 2.247%. Volatility index is falling today. Currently, we're reading 17.29. UUP is mostly unchanged. Gold having a really nice move. Great start here to the morning. Now starting to consolidate. Really looks like a nice flag forming intraday. USO looks like a reverse flag. Really difficult morning, and now consolidating that move. Currently reading at $12 for USO. TLT is up 56 cents at this point. Looking pretty good for that. With taking back some of those losses from yesterday, it looks like. All right, and as far as our sector summary goes, we can see that the leader is consumer discretionary today, having a great day, up 0.85%, with energy and utilities being the losers right now today. Energy is actually down over 1%. All right, back to you, Tom.
All right, sounds good. I'm going to go in and I want to take a look at the SMH. You know, we had Dan Russo on. He was talking about how important he feels the semiconductors are in trying to determine which way the market goes here. And there's no doubt semiconductors have been leaders to the downside throughout May. I did want to point out on the SMH, because I talked about the positive divergence a couple of days ago, and we did have one more gap down yesterday morning, but we're starting to see strength. And for the first time, we got back up above that 20-hour EMA, first time since mid-May. But now we're trapped. Can we get through the 50? We've pulled back down. We're testing the 20-hour EMA, which is now starting to rise for the first time, which it did back in mid-May. But notice there, we rolled back over. So the question for me is whether we're going to break out to the upside or break down. One of the keys is going to be Intel. Intel is over 11% of the SMH. And when you look at the hourly chart on Intel, it has actually moved back into positive territory. The 20-hour has crossed above the 50. You can see the hourly PPO has turned positive. So Intel is beginning to give us a sense that the SMH is bottoming and starting to turn back to the upside. Now, if both of these roll over again on the hourly chart, I would be very cautious because we are in a steep decline on the daily chart. But this is an area that I'd be watching closely for a possible rebound. All right, we're going to go into our final segment of the day, which is Under the Radar. For those of you who maybe have not been here before or maybe haven't seen Under the Radar, essentially Erin and I are just going to be looking at stocks that, I don't know, maybe you're just unusual or interesting to us in some fashion. It could be a stock that's just waiting and consolidating for a breakout, the fact that the market's been so weak. But we just had, there's something that's kind of piqued our interest and maybe is under your radar as well. So, Erin, I'll let you start off. What do you have for Under the Radar?
All right. Well, since you were talking Intel, I'll go ahead and throw Intel up there. You know, I know that I've got AMD as well that we're going to look at, and I know they're not under the radar as far as names go. But I am starting to see some improvement with those semiconductors. And, you know, given what Dan was talking about earlier today, we certainly want to see that kind of a move. But you can see that we're very oversold right now on Intel. Starting to finally see that PMO turning back up. Could end up getting that PMO buy signal coming in. Notice also a little bit of improvement here on the scooter. And OBV, it's flattened out here, and we've got this top slightly higher than that top, I believe, or even just the same. Rising bottoms here on the OBV coming out of this. Really, it was more of a decline in here, at least consolidation sideways. So I don't know. I think Intel looks pretty good right now. This is a problem, of course. The 50 is about ready to cross below the 200-day EMA. So that gives me a long-term trend model sell signal. But I'm not ready to throw this one out just because of that. I mean, obviously, we had a huge decline off of the top we had back in mid-April. It's been a really painful ride down, I'm sure, for some who are holding this stock. But I think we might be getting ready to see a turnaround here. And so even though I'm seeing that long-term trend model sell signal, I'm willing to go ahead and keep Intel on the radar. Now it's under the radar, but now it's on my radar and hopefully yours. AMD's obviously similar space. I like this one better just because it's clearly performed better. Even, since its top in April, it's moved mostly sideways. Whereas we saw in the Intel chart, super long, super big decline down there. So I think this one has a little bit better, it looks better. It's stronger. You've got a scooter that's in the hot zone. You've got OBV volume, bottoms rising. When you can see during that period of time, the bottoms were mostly even. So that's a positive divergence. And then I always like it when you see a bearish pattern and then you get a bullish conclusion. So to me, it's especially bullish when I see that. We had that breakout, and now we're pulling back to the breakout point, and we're sitting right on it. I would expect to see a turnaround coming up pretty soon for AMD, even higher prices. And let's see, next up, let's look at Exact Sciences. And this is a biotech, but I really like the way this chart is shaping up. And I will annotate it for you right here. Okay, so first of all, there's our support and resistance line looking at that top we had back here in April. Next up would be, of course, that high in May, earlier in May. So I like this. You can even see here in the thumbnail, you could almost make a case for a rising ascending triangle here. But mainly what I like the best about this is that breakout above the top. And we already had the breakout above these two tops back here from February and March. PMO is turning up. We don't quite have the buy signal yet, but look at the strength, the relative strength of Exact Sciences here. Really good to see these 90s, 75 and above for quite some time, most of the year. So it's a strong stock, I think, in an interesting space right now. Let's see, next one. This was an interesting one that I saw come up on my radar. And it's not something, it's a ETF, so I don't usually pick ETFs, but I thought this one looked really good, and I'm going to explain why. So first of all, we'll get our trusty support resistance line that really lines up with bottoms we're seeing back here and these tops from here. But if we bring it down to that low back here from March, we've broken out. And you can see if you do a little bit of a trend line here, we have a triangle, right? A symmetrical triangle. Well, typically they're continuation patterns. So you would expect to see a breakdown out of this triangle, but instead we got a breakout. It's above that low that we saw back here in March. And look at that lovely PMO rising and getting ready for a buy signal. Yes, 5,200, a little bit concerning. The 50 is only 1/100th of a point above the 200. So we should end up seeing that long-term trend model sell signal. However, with price so close to the crossover area, I would expect it to end up whipsawing if we continue to see a rally here on Exact Sciences. But I really like this chart. Oh, look at the scooter too. I wanted to point that up. Really building that in relative strength. And we looked at Intel, so let's look at Trade Desk real quick. And this one, it's the PMO's more flat, but look at the relative strength here. It's a strong stock in a strong space. Looking at a symmetrical triangle off of this short-term uptrend could maybe make a case for a flag, but I would expect an upside breakout here to get us just above that 230 range. So those were my under the radar. What do you have for us, Tom?
All right. Well, I'm just going to start off first. Taking or going through a couple of industry groups that I wanted to consider. And, I kind of gave away the, let the cat out of the bag earlier saying Facebook was going to be one of my under the radar stocks. And one of the reasons why is when I was looking at internet stocks, this has been one of the best groups over the last 6 months, but it's been one of the worst groups over the last month. And you can see here relative to the S&P 500, we've had a drop, but I think it's setting up an opportunity. Because when you look back, normally when we get above the 20-day moving average, we tend to stay above that, as you can see throughout much of 2017. And then when we trade back below it, then of course we have to, be careful. But here we've been trending above that 20-day, and we're starting to hook back up again. So I think that this is a space that we want to consider. Another area that I'm looking at is waste and disposal services. Now, this one has been doing extremely well in May. And you might say, well, that's not under the radar. Look at it. It's been taking off. Well, it's not really taking off. If we look at the chart, the absolute chart on the group, it's sideways consolidating here in May. So you might look at it and say, well, this stock, this group's going nowhere, so why should I be interested? Well, you should be interested because the market's getting killed. And this stock is, or this area of the market is not. So on a relative basis, you can see we have had a huge breakout over a multi-level relative high, or multi-year, I should say, relative high. And we are bouncing off of that rising 20-week moving average on a relative basis. So I think this is another area that I want to be thinking about some individual stocks. And then finally, I know when we heard from Dan earlier, he was talking about some of the insurance stocks. Well, insurance brokers, look at what this group's been doing. And look at what is happening in May. We're starting to see more relative strength in the financial area, number of the groups within financials that Dan had alluded to. And this is one that's really caught my eye, the insurance brokers. And once again, if we type in the group and we look on a absolute basis, we did break out about a week ago, but for the most part, the last 6 weeks we're consolidating. But that's a good thing when the market's going down. That's telling us that money is still rotating into this group, even though it's coming out of the market. The net effect is that there are more sellers than buyers, yet this group continues to trade well. So I'm going to go through a number of individual stocks and go through them rapidly in these three areas of the market. Facebook, talked about earlier, the big gap up. I think it's back down near a key area of support, the 50-day. You can see the relative strength lines are pretty good. Facebook trying to break out relative to its group. And with the group, as I mentioned earlier, possibly bouncing, you want to look for leaders. And I think Facebook's beginning to show that again. As far as some other stocks within this space, how about Netflix? Now, Netflix has been holding this area of support around 340. The market's fallen back. We're definitely showing a lot of weakness. But since probably a month ago, you can see that Netflix relative to its peers is actually starting to strengthen again. And over the last week to 10 days, quite a bit so. So I think that the fact that we're holding here is a really good sign. Watch for Netflix, especially if we get back through that 50-day moving average. Twitter, another name in this space. I think Twitter is right at gap support, the top of gap support. This is a stock that I'm really liking here. Again, with expecting internet stocks to begin to ramp up again to the upside, I think this is giving you an opportunity. Stock was up 41 at the beginning of May. Now you got it back down at 37. I think it's an opportunity. Snap, mentioned this one earlier as well. This one is actually trying to make another move and break out. Volume picking up a little bit here on this push to the upside. Today, already 20 million shares, still got 2.5 hours to go. So pretty good volume. And look at the relative breakout or potential relative breakout we're seeing here. Another good solid stock. IAC, Interactive Corp, still in the internet space. Look at the recent lows coming in around 220. The stock was over 240 back earlier in May. Yes, the volume's been heavy. So if we lose that 220 area, I would be a little bit more concerned. But I think you can keep a fairly tight stop. If this level holds, I think we can make another run at 240. That'd be almost 10%. GoDaddy, GoDaddy is one that is holding this area of price support. It is below its 20, and the 20 is below the 50, and you can see the relative strength just been going sideways. So if we break this area around 73, I'd grow a bit more cautious, but for now it is holding support. JCOM, another one. Look at this right at this support area on a relative basis. It has been putting higher lows in, so it's beginning to show some nice strength. In the waste area, let's pull up Waste Management, one of the most well-known companies. Look what's happening here in May, setting new highs. What pullback in the market? You don't see it here with Waste Management. A great relative strength leader. I think Waste Management's one that is probably under the radar on many folks' screens. You go through, look at Waste Connectors, Waste Connections, same thing. Moving up, look at the volume coming in. Look at the relative strength, trying to break to a new 52-week high. I think that's a solid one. CWST, Casella Waste Systems, smaller company, but moving up. Volume can be a little bit lesser today, only 56,000, but for the most part, 150 to 250,000 shares or more. But again, when you're looking at relative strength, it is right up near its 52-week high. So you got a good group that's been holding up, and here's a stock sitting right on its 20-day moving average. I think CWST looks good. And then finally, in that insurance space, how about Aon, AON? Look at the relative strength here. It's continuing to try to break out. Look at the relative strength as we go down. It's breaking out relative to the S&P 500. It's one of the stocks, or one of the best stocks relative to its peers. I think Aon looks like it wants to break out. Marsh McLennan, MMC, another one in this space, making a breakout a week ago, pulling back, nice reversing candle yesterday, a bullish engulfing candle on increasing volume. This one, because it is downtrending, has a longer-term downtrend relative to its peers. Probably want to keep that 50-day moving average as a stop, but I think MMC looks good. And then the last one I have is a smaller company in this space, GSHD. I like this pullback back to the 20-day moving average. Also notice that we broke out above this double top at 36. Volume increased. Yes, the volume's been heavy on the way back down, but we haven't lost price support. I think as long as we hold about $35 on this stock, I think this is one that could be a real winner going forward. Also keep in mind, this is a small cap company, and I've talked about this on Market Watchers Live in the past, but small caps have their best relative month in June. Over the last 20 years, it's not even close. So this is a stock that maybe you might want to consider for those reasons. Here is our summary of all of the stocks that we just covered. We went through a bunch, Erin, under the radar, and we'll find out later if they truly are under the radar or if you want to throw them out the window.
Well, I think we've got a pretty good record here. I don't know.
Yeah, I don't know. I think, we've certainly had some good calls, and as anybody calls the market, we've certainly had our share of bad calls. But I think Larry Williams yesterday, when he was on the show, I think said it best. You just have to manage your risk. It's not about being right all the time. I'm not going to be right all the time. That's for darn sure. I'm pretty sure you're not going to be right all the time. And none of our guests are going to be right all the time. None of our viewers are going to be right all the time. Got to keep those stops in play and make sure we manage our risk.
Right. Well, and the fact we disagree, not always, but I think it gives perspective.
Yeah. It definitely gives perspective, and also giving perspective today is this triple top on the Dow so far on an intraday basis, rolling back over. Not exactly a huge rally here, but I do think end of the month into the beginning part of June should, typically we see a rally. Again, that doesn't give us any guarantee. I'm not trying to say that we're guaranteed that we're going higher, but it is something to consider, I think.
Yeah, we're pretty oversold. I mean, and everybody is bearish. So it's usually a sign of a reversal soon.
Yeah, and I think Dan made a great point about the semiconductors. If they rally, chances are the overall market will rally because semis certainly have been hurting us.
Yeah, and they're looking good.
There's our upcoming schedule. You can see a couple of really good guests coming up. I do want to thank everybody for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody, and we will see you back here tomorrow. Happy trading.